the government of the United States is buying back its own debt at a record pace. But why would a country with over $37 trillion in debt decide to repurchase the bonds it itself issued? Today, you will understand what is behind this movement and how it may affect the value of the dollar, global inflation, and consequently, your wealth. Based on official data from the American Treasury and market analyses. If you want to comprehend the real logic behind the decisions that shape the global financial system, subscribe to the channel now, like the video, and let's get started. The government of the United States is repurchasing its own debt securities. In practice, the American Treasury goes to the market and buys back the bonds it issued years ago. This is not the same as the Federal Reserve printing money. The Fed controls interest rates, regulates banks, and implements monetary policies. The Treasury, on the other hand, is the government's treasury. It collects taxes, pays pensions, salaries, and executes the budget approved by Congress. They are different entities with distinct objectives. So why is the Treasury buying back its own debt? And, more importantly, why is it doing this now, after a decade without engaging in this kind of operation? The simplest analogy is to think of a citizen who uses a new loan to pay off another one early. They pay one bill, but open another. And here begins the curious part. Historically, the American Treasury has rarely done this. Between 2003 and 2013, for example, there were no repurchases. But now, the volume of these operations has skyrocketed. Only this year, the Treasury has already repurchased more bonds than in the entire previous year. Something is clearly out of the ordinary. Is this an attempt to reorganize the balance sheet, or a sign that the government is losing control of its own debt? These questions are not merely theoretical. They strike at the heart of the global financial system. Because when the largest debtor in the world starts acting as though it is buying time, the market pays attention. But why would a government that already owes trillions do this now? This is where the game starts to get really interesting. Today, the total debt of the United States exceeds 37 trillion euro. It is a number that is almost impossible to visualize, but it grows every day, and at an increasingly accelerated pace. In this fiscal year alone, the deficit has already surpassed 1.6 trillion euro. In other words, the government collects an enormous amount in taxes, yet still spends much more than it receives. The difference between what it collects and what it spends is covered by new loans. And these loans take the form of the famous American Treasury bonds. These bonds are in practice promises of payment. When someone buys a bond, they are lending money to the government in exchange for future interest. And, to a certain extent, this is normal. Almost all countries do the same. The problem lies in the size and speed at which American debt is growing. The current rate of borrowing is so high that the government constantly needs to issue new bonds just to pay off the old ones, which turns into a vicious cycle. Now, with the highest interest rates in recent years, this cycle has become even more expensive. Bonds of 20 or 30 years have significantly higher interest costs. To alleviate the budget, the Treasury is trying to swap part of this long-term debt for short-term debts, papers that mature in 3, 6, or 12 months and pay slightly lower interest. At first glance, this seems like a smart move, replacing expensive debt with cheaper debt. It appears intelligent at first glance, but there is one detail that changes everything, and almost no one notices. Short-term debts mature quickly and need to be rolled over constantly. If rates rise, again, the cost of this rollover could explode overnight and practically without warning. And it is precisely this that many economists are beginning to see behind the scenes in Washington. But what if this strategy is not just a technical mistake, but rather a sign of something deeper, perhaps even of desperation? The central point that hardly anyone comments on is this: the American government is not paying off its debt with leftover money. It is going further into debt to buy back what it already owed. Does that seem confusing? It is like paying your mortgage with a credit card. Immediate relief, but a financial time bomb ready to explode. This strategy of rolling long-term debt into short-term debt creates a structural problem. Each short-term bond matures quickly and needs to be renewed. This means that the American Treasury will have to refinance a huge portion of its debt several times a year. Any sudden change in interest rates can create a real fiscal shock. If the cost of credit rises, the government will need to pay even more to finance itself. And this extra cost falls on the federal budget, already strained by spending on defense, social security, and healthcare. But the danger is not only financial, it is also psychological. When a government needs to buy back its own debt to show strength, the effect can be the opposite. It signals weakness. It is as if it were telling the market, "Don't worry, we ourselves guarantee the liquidity of our securities." However, this exactly raises the concern it sought to avoid. Investors begin to wonder, why does the Treasury need to create artificial demand for its bonds? Where are the natural buyers? Pension funds, banks, foreign governments. Confidence is the invisible asset that sustains the system, and once it begins to wear thin, markets start to react unpredictably. If even the most powerful government in the world needs to fabricate liquidity for its own market, what does that reveal about the stability of the global financial system? Are we witnessing a technical maneuver or a symptom of something much deeper? Because if this operation does not improve the budget, does not reduce the debt, and still increases the refinancing risk, what is the real reason behind it? It is precisely this that begins to raise suspicions among analysts and investors. And that leads us to the next point. What is the Treasury trying to hide with these accelerated buybacks? What appears in the public documents from the Treasury is what they call liquidity support. The government is trying to ensure that the bond market continues to operate normally, even when natural demand begins to fail. At first glance, this seems like a technical measure, but in practice, it is a clear sign that something has changed in the confidence of the system. The real problem lies at the long end of the yield curve, the bonds of 10, 20, and 30 years. For decades, these securities have been viewed as the safest assets on the planet, the foundation of the entire global financial system. Banks, insurance companies, and foreign governments would purchase them without hesitation. Today, investors are demanding higher yields to continue lending money to the United States. Some have simply stopped showing up to the auctions. In light of this void, the Treasury is taking on the role of buyer of last resort. It is repurchasing a portion of these old bonds to ensure that the market remains liquid, that there are buyers and sellers, and that prices do not collapse. What is bizarre to consider? Imagine if Apple started buying used iPhones just to prevent the price of the older models from falling too much. It would not be solving the problem, merely hiding the symptom. When an asset needs artificial support to maintain its price, it ceases to be truly safe. The market begins to perceive that there is a silent manipulation underway, an attempt to sustain confidence where it is already weakening. And here lies the question no one wants to ask. If even Treasury bonds need support, what in the financial system can still be called risk-free? That is precisely why experienced investors are returning to protect part of their wealth in assets independent of the system. Reserves that do not depend on the credibility of governments or central banks, and that protect wealth from inflation. But the question that remains is, what does all this mean in practice for the average investor? That is exactly what you will understand now. What are the 3 practical initiatives to protect your wealth and your family? The first visible impact of this repurchase policy is the increase in volatility. Interest rates fluctuate more dramatically. The exchange rate reacts with uncertainty. And the dollar, which has been synonymous with stability for decades, begins to face gradual long-term pressure. When the largest issuer of debt in the world starts to refinance its own obligations in short terms, the market perceives the embedded risk. And attentive investors know where there is instability, there is also opportunity, but only for those who are prepared. So how does a smart investor protect themselves in such a scenario, without falling into alarmism, yet also without being exposed? Part of the portfolio should be directed towards assets that preserve real value, such as gold and silver, especially during periods of loss of confidence in fiat currencies. These metals do not yield interest, but function as a silent policy against excessive global indebtedness. Another component, increasingly considered, is Bitcoin. It has become a digital reserve of value precisely because it does not depend on governments, central banks, or debt issuance. It is a decoupled alternative, an asset that reacts differently when the traditional system shows signs of tension. It is clear that the price can fluctuate, but it is this independence that makes it relevant as a partial protection within a broad strategy. In fixed income, the path is to diversify maturities and issuers without concentrating everything in long-term debts of the American government. The rule is simple: combine liquidity and protection on one side and gradual growth on the other. Consistency is more important than speed. So going back, consider that these Treasury repurchases do not announce an immediate collapse, but expose a system that increasingly relies on confidence to function. And confidence is always the first link to break when logic begins to fail. But before concluding, there is one final lesson that needs to be said, and that summarizes this entire movement in a single message. The American Treasury is not buying stability, it is buying time. Each debt buyback postpones the problem but does not resolve it. When the world's largest debtor needs to support its own market, this is not a demonstration of strength, it is a warning sign. And it is not the only country facing issues with public debt. This is a global problem. And if you want to understand what might happen now because of this, watch the video that is appearing on your screen. We will see you there.